Two people, the same money, 20 years, and only one difference. Two people, same age, same salary, the same 50,000 saved. One buys a rental, one buys an index fund. 20 years later, both are genuinely wealthy. So this should be a simple story with one clear winner. It is not. The surprising part is how close they finish and how differently they got there. Because every video on this topic only shows the flashy number and skips the rest. Today, we are going to look at the whole bill, all of it. We will run the honest math, the numbers they put on thumbnails and the ones they bury in the footnotes, so by the end you know which one fits your life. So let us start with the one rule that nobody in this debate likes to admit. Each side shows you only half the bill. Meet our two savers. Same paycheck, same $50,000, same city, same starting line. From here on, only one thing about them is different. The first one puts it all down on a rental property. A real house, with a key, a tenant, and a rent check that lands on the first of every month. The second one puts the same money into one broad index fund. No key, no tenant, no story to tell at dinner. Just a slice of thousands of companies at once. And here is the rule for the whole video. There is no free lunch, only a bill you can see and a bill you cannot. Both of these have both. One is visible, solid, and quietly impressive to everyone around you. The other is invisible and boring. And that feeling, as we will see, is very expensive. For the first year, the landlord feels like a genius. Rent arrives, equity builds, the neighborhood ticks up. Everything looks exactly as advertised. The index owner feels almost nothing. He checks it now and then, watches it drift up a little, down a little, and mostly just leaves it completely alone. Now the flashy numbers. The landlord adds up his rent for the year, and it looks wonderful. That big total is the one he quotes to his friends at the barbecue. The index owner has a flashy number too, about 10% a year on average, over the long run. That is the figure every stock channel puts on the thumbnail. But before we go spending either of those numbers, hold this line for the landlord. Leverage builds the wealth. Weekends pay for it. Here is real estate's superpower. He put down $50,000, but controls a house worth 5 times that. His gains ride on the whole house, not just his cash. So when the house rises just 3 or 4% a year, he earns that on the full price, using the bank's money for the rest. That is genuine, powerful wealth. But now the bill he does not post online. That lovely rent total is not what he keeps. Watch how much comes out of it before a single dollar reaches him. Property taxes and insurance, every year, no matter what. A month of empty rooms between tenants, where the mortgage still comes due with nothing coming in. Then the repairs that arrive in chunks. A roof every 20 years, a furnace, a water heater, each one thousands of dollars, and never at a convenient time. Add management. Pay a slice of every rent check, or do it yourself, which means night calls, weekend showings, and a part-time job you never get paid for. And the big risk. Some months, no rent comes in at all, while the mortgage still does. A long, empty stretch like that can cost you a whole year of profit. Run all of that through, and the flashy rent total quietly shrinks to a thin trickle of real cash. And that is before you count 1 hour of his own time. So the cash flow was mostly a story. The real prize is the leverage and the loan paydown, quietly turning a small down payment into a large pile of equity. Now be just as honest about the index, because if we only questioned real estate, we would be doing exactly what every stock channel does. First, no leverage. His $50,000 controls $50,000, not $250,000. No bank money is doing the heavy lifting, so it grows slower at the start. Second, no monthly check. The index does not mail you rent. For years, it is just a balance on a screen, quietly growing, giving you nothing you can spend today. Third, and this is the hard one, it drops sharply. In 2008, the market fell about 37%. In early 2020, it lost roughly a third in a matter of weeks. Imagine watching $150,000 fall to $95,000 in a month, on a screen, while every headline warns that it is going lower. The strategy works perfectly on one condition. You hold through all of it and keep buying. The math is flawless. The problem is the human being holding the mouse. Because most people do the opposite. They sell near the bottom, buy back after the recovery, and the average investor gives up a real slice of the return that way. So that lovely 10% is only real if you can sit still and do nothing while everything around it is dropping. Most people simply cannot. Remember the rule: no free lunch, only a bill you can see and one you cannot. The index bill is not weekends, it is nerve, paid in stress, not in time. So here is the honest catch behind the quiet winner. It asks nothing of your weekends and everything of your nerve. The index only wins if you can sit still. Now run both paths out 20 years. The house is nearly paid off and worth far more, so the landlord is sitting on a large, real pile of equity. The index owner, who just kept buying and never flinched, is sitting on a large pile too, and almost all of it is pure compounding, not money he put in. And here is the surprise. After 20 years, the two of them land in a surprisingly similar range. On the scoreboard, it is close to a tie. But look at what each one paid. One paid in hundreds of weekends, real debt, and constant surprises. The other paid in years of white knuckles through the downturns. Now the move that changes everything. If the index owner raises his monthly amount a little, compounding turns that small change into a much bigger finish. To grow the rental the same way, the landlord has to buy a second house, take a second mortgage, and double a workload that was already eating his weekends. So who should pick which? Real estate can clearly win when the rent is high enough compared to the price, and you treat it like a real business, not a side hobby. If you know your local market, screen tenants well, budget for the big repairs, or live in one unit and rent the others, the numbers can get ahead of the index. The index clearly wins if you want simple, spread out, and liquid, with no tenants, no repairs, and no weekends spent as an unpaid property manager. And it wins if you know, honestly, that you would sell too soon the moment things got rough. Knowing your own temperament is half of this whole decision. And if you can do both, own in a strong rental market while you keep feeding the index every month, the math on that combination quietly outpaces either one alone. So the real question was never which one wins on average. It is much simpler and much harder. When you compared them, did you honestly count everything? So keep this one line above every pitch and every thumbnail you will ever see. The honest number is the one that counts everything. If this gave you the real version instead of the thumbnail version, subscribe. Every week we break down one money decision fully, the whole bill, not half of it. Because we did not crown a winner today, and that was on purpose. The most interesting answer is not one path or the other. It is what happens when you combine them. Next time we run the numbers on doing both at once and show how the two strategies, stacked together, can quietly build wealth that neither one reaches alone. Count everything, then choose. We will see you next week.